Everyone should be getting a recording of this automatically to the email that you use to get to today's webinar. So you don't need to ask about that. It should be automatic. If you haven't gotten it within a day or so, then you can contact Magellan at neowave.com. That's Magellan, Magellan at neowave.com. And he can send you the recording. Okay, this is going to be more of a free-wheeling kind of presentation. It's not highly structured like I would normally do to present all the concepts. It's more to allow the public, people who haven't been exposed to river theory to ask questions and stuff like that. I'm going to go over a general sort of review of the process for those who aren't familiar with it, just so you get an idea of what it's about. I started this project 25 years ago, and I spent hundreds of thousands of dollars on programming and development of this. Probably lost a lot of that money too in testing ideas. I've spent at least probably 200,000 hours working on this project since about the year 2000. And it wouldn't have been possible if I hadn't spent the prior 20 years or so with wave theory and realizing that from that process that forecasting is not really the answer to making money in markets. It can save you from disasters. It can help you at major turns. It can help you, avoid big problems like the crash of 87 or the peak in 2000 or the peak in 2007, things like that. But wave theory is more big picture. And I started to learn after about 20 years of trying to use wave theory to trade with that there was a lot more to trading and investing than just predicting what was going to happen in the markets. So the point of the presentation today will be to sort of lay the foundation of the concepts and then allow y'all to ask questions about the whole concept and how it works. I couldn't have done this webinar even probably 2 or 3 years ago, this type of webinar, because I was still working on each piece of the puzzle. This is a very complicated, multi-dimensional puzzle when it comes to trading markets and money management and having to logically deduce the concepts and the foundation, define them to programmers so they could program these things into TradeStation. Unfortunately, this turned out to be way more complicated than doing wave theory. I would have never imagined that wave theory would be less complicated than trading, but that's what turned out to be the case. So it only took me about 5 years to lay out the vast majority, say 90% of all the wave theory concepts that are presented in Mastering LA Wave. And it's taken me 25 years to do the same with this Neely River trading technology. Okay, so let's first of all talk about the main problems that most traders face when it comes to markets. The first thing is generally a constant level of uncertainty about what's going to happen, if their forecasts are going to work, which creates a lack of confidence in their approach or their abilities. That creates a lot of emotionalism when it comes to trading, because you're never quite sure whether you're going to be right or wrong or what to do if you're right this time and all these kinds of things. When it comes to a predictive approach to markets, you're having to predict everything, and that requires near perfection in every step of the process. The prediction of what the market's going to do, prediction of where you're going to get in, prediction of where to put your stops, prediction of where to exit. And all that's going to be emotionally driven because you never know for sure if this time your forecast is right or wrong. Most people end up, because of that process, exiting profits too soon and holding on to losers too long, because they exit because when they're making money, they think, oh, I got to take my profit while I have it because I might lose it, because they're so used to being wrong or losing money. And when they're losing, they don't like to admit that they're wrong psychologically and maybe based on their ego. So they tend to hold on to positions that are losing for too long. Another big mistake most people make is only following 1 or 2 or 3 markets. That automatically limits potential. Sometimes I remember back, say 10 years ago, I was only following 4 markets at the time, the S&P, T-notes, gold, and the euro currency, and I was using ETFs to do it. And 3 of those 4 markets went nowhere for about 3 years. I mean, absolutely nowhere, and they could not be predicted with wave theory at all. So I just couldn't do anything with those markets, and it made it very difficult. Um, the Another problem most people have is they're trying to apply only one trading style to their investment approach. So they decide I'm going to be a trend follower, and they might use moving averages, things like that. They're going to be a bargain hunter, which is mostly fundamentally based, waiting for stock to be below its current estimated value or things like that. Are there those who use forecasting technology like wave theory or overbought, oversold indicators to try to pick tops and bottoms? But markets operate on all 3 dimensions at different times. So sometimes you're in an environment where bargain hunting works, fundamental technology. Sometimes you're in a trend following environment. Sometimes you're in a top and bottom picking environment if you're in a big consolidation for a long period of time. So all of them have their time when they work and then time when they don't. So if you only pick one of those styles, then 2/3 of the time, you're not going to be able to make money because you're using the wrong approach. And focusing on only one time frame is a huge problem. I didn't realize until the last few years how big of a problem that is. But most people say, well, I'm a day trader, or I'm a long-term trader, or I like trading hourly, whatever they decide to use. And that is something that will drastically limit your ability to trade successfully, because markets not only behave in different ways in different time frames, like sometimes they're trend following or top and bottom environments or bargain hunting environments, but also different time frames are going to be more likely to be tradable than others depending on how active the market is. So you never want to just pick a daily, weekly, or monthly time frame. You want to be able to trade all time frames and let the market decide these things for you. So my goal with river theory is to try to define all these aspects of trading, investment, money management, stop placement, position sizing, time frame selection. All these problems had to be solved. Market selection, which markets are good, which ones are bad, or which stocks are good. All these things had to be solved. It was done piecemeal, little by little, over the last 2.5 decades. So the innovations of river theory are designed to solve all of these trading problems, and it creates an entirely new way of thinking about markets. So you can objectively determine the direction of a market, whether it's a safe market to enter, where you would enter objectively, where you objectively place your stops. These are things you don't personally decide or predict, they're determined for you. Picking the best time frame to trade is crucial, and the correct trading style, and which markets and maybe arenas like ETFs or sectors are the best ones to focus on. So river theory addresses all these different aspects, and it helps, because it does this, it helps to remove all the emotions of trading, the subjectivity, the irrational decision making that can occur when the markets get volatile. It helps you avoid getting rid of profitable positions too soon, and it lets you quickly and logically and rationally get rid of losses very quickly. It's going to allow you to pick a time frame that's appropriate for trading, so you don't personally decide this information. The markets decide it. You don't decide what trading strategy to use, such as trend following, bargain hunting, or top and bottom picking. It decides that for you. You don't decide where to place stops and targets. The market decides that for you. So you're removing all these factors that involve emotion, ego, decision making that can make people make lots of bad decisions. So it becomes a far more rational, objective, unemotional, and profitable kind of endeavor. So let's take a look at some of the concepts, and we'll go from there. And it's going to be sort of just randomly, step through this process, so it's not going to be highly organized. Okay, so let's begin with the general structure. This chart, which some of you may have seen before, is something that's taken me about 2 decades to figure out. And that's how markets and individual stocks, sectors, whatever, behave like water moving through a river. Because the price of a stock, a company, index, it never stops. It always is going and going and going, just like water flowing through a river. The different types of trading are related specifically to the different kinds of environments that you have in a river. So you have sort of slow, more methodical, but choppy kind of trading that occurs near the perimeter of the market river, just like you would have if you were, in a real river where the water is sort of turbulent in this area. Then you get to a point where it starts to trend more, and you have stocks that are more trendy, which is going to be the trend following kind of environment. This will be the bargain hunting or fundamental environment. And you have the acceleration environment, where it's going to be based mostly on psychology and emotion and public euphoria, public pessimism, things like that. So these three different regions explain the three different types of trading that are possible, the three different types of environments that exist in markets, and everything that I'm going to be showing you is founded on these concepts and using this structure to understand how everything else needs to be designed. It's been a very, very long, drawn out kind of process. I'm going to go to actual TradeStation charts. And this is the software that I've been paying programming to develop for a very long period of time. And the scanner takes the concepts and information of this chart here to find stocks that are in the right condition for safe trading. So it's looking at it from a large scale monthly river perspective, and it's making sure that there's momentum. If you're moving from the edge of a river, as you move away from it, it has to start speeding up as it gets closer and closer to the middle of the river. So you want to have evidence of momentum. You want to have evidence of power in a river, its gravity, in markets, its volume flow. So you want to have evidence of power, in this case, money pouring into the market, and evidence of momentum. You want to have evidence of direction. So the market starts making new highs and new lows. You want to have information regarding the speed of movement. So you know all the main criteria of the stock and how it compares to all the other stocks in the world, and whether it's going to be a viable consideration, not a definite buy or sell, but whether you should consider it. So this is the monthly river conditions, and it shows, if it's all green, it shows you that this stock meets all the criteria for a potentially safe investment. It doesn't mean it's time to do it. It doesn't mean it's ready to happen right now. It's something you can then consider. So after it's produced a scan over here that says this is a good list of stocks based on these criteria, you test it out. And if it meets those criteria, then you can move to the next step. And the next step has to do with time frame selection. The faster a market moves, the tinier, or the faster anything moves, such as sine waves, radio waves, sound waves, anything that moves very quickly will move in a tinier space. The slower it moves, the larger the oscillations can be, such as with sound waves and things like that. So we need to know how quickly a market's moving to know which time frame is going to be the best time frame to trade. So this again is you not deciding I'm going to be a day trader or a weekly trader or an hourly trader. The market's telling you what time frame is going to be appropriate for trading. So if the mark was in this area, in this range, you'd be looking at monthly charts. If the dots were in this range, you'd be looking at weekly. But the current active dot, and you can see the color over here, is telling you daily charts of the appropriate time frame to trade. So on this side, I've picked daily. If I pick the wrong time frame, it's going to yellow the chart out, warning you that this is the wrong time frame, and it tells you up here which time frame to go to. So you now know that you're in a trending, accelerating, strong river environment for this particular stock, and now you know which time frame to focus on. And if a market's oscillating on a daily basis, it's going to be oscillating around certain kinds of moving averages that are appropriate for that time frame. So this is what I call my mode index. It's a very specialized, secretive. I never told anyone how this is created except for Stefan, my programmer, but I've been using this for about 30, 40 years, and it gives very good overbought, oversold, buy signals, trend analysis, and it's very sophisticated. So here you can see where it's warning that the market might be topping right before it's sold off. Here you can see where it's given a buy signal right near these lows, and the green indicates that we're in an uptrend. So on this time frame, which is daily, it automatically adjusts everything on this chart to fit the fact that we're looking at a daily time frame, not a weekly or a monthly. So the charts automatically adjust based on the information here in which time frame is appropriate. And it's telling us that the financial conditions are improving for this company, which is good. And that the oscillation, it's going to oscillate above and below and above and below. Let me see if I can show a teeny bit of history here. Okay, so you can see it was in a downtrend over here, and then it turned into an uptrend, and it's been oscillating back and forth around that upper line. So we're now in the downward oscillation within this upward trend. So this chart is telling us that not only is it the market strong, but we're in an uptrend on a daily time frame, and the financials are improving. So everything is green on this chart too, and these dots are inside or below this upper line. So we're in the downward oscillation before the next possible advance. So these two charts take care of fundamentals across the two bottom areas, technicals across the two here, and this has to do with psychology. And the psychology is then going to be replicated on the next group of charts. So we now have everything we need to consider actual entry. We know it's a strong market. We know it's trending. We know it's accelerating. We know how it's oscillating. We know whether it's safe to get in. And now we want to get the psychology right for potential entry into this stock. So NRT charts, which are what all these charts are about on a daily, weekly, and monthly time frame, NRT charts are about the psychology required for the safest entry into a market. If you're in a trend following environment, there's certain criteria that you want to wait for that show that most of the people who are trading this market are doing the wrong strategy at the wrong time with the wrong kind of channeling, the wrong kind of stops. And when that condition is met, it's going to show a green bar like it's doing right here, indicating that this is a market where psychologically the conditions are right for entry. And you can see it gives a very specific stop. So this is not something you predict. It's not something you have to worry about. It's automatically spelled out based on who's in control of this market. In this particular case, it's the emotional top and bottom pickers that are in charge. And you're waiting for a certain group, in this case, the trend followers, to be stopped out of their position so that you can get in. And that's why this bar is green. So it's indicating that from all perspectives, we have speed, accumulation, direction, trend, financials, and psychology, all telling us that this is a market that is ripe for entry, and you know exactly where to put your stop, and that's it. So this would be one stock that would be potentially ready for entry. Notice these charts are yellowed out because they're not moving at the right rate to make these safe time frames to trade. So it's focusing on the time frame that's best to trade. The scanner here goes through about 12,000 stocks in the US, and it finds generally only 20, 30 or so that meet all the criteria necessary for potential entry. And the only thing it doesn't properly analyze is this part, so you need those charts to look at. And it currently doesn't do the financials, so that is down here to take a look at that too. So you have to make sure that what it brings up is appropriate. So let me start at the bottom here. These will be the slower moving stocks. You notice these black lines here separate the monthly potential entries from the weekly potential entries, and then from the daily, which are at the top. So I pull up this particular stock because it's in the monthly category. I need to move to the monthly time frame. You can see here from a monthly perspective, everything is this is a bluish green because it's not moving that fast, but it's still considered a viable option to be an early kind of entry. But everything is basically green here, and you have everything green over here. And if you look close, you can see that is currently oscillating below the upper line, which means it's in a downswing during this larger upswing. And this means you can look to try to get in if the psychology is right. So I'm going to go to the next page. And on this chart, there's certain rules required for each entry environment. Let me show these. This is all spelled out if you were to take the class on river theory. It shows you the kind of environment and behavior you want to see for each kind of trading environment. Bias has to do with the bargain hunting or the fundamental environment, and it's showing you where you want to enter and how you're going to hold your positions, what percentage you're going to hold of your positions, and what you need to see to get in. And it spells out the criteria. And you'll notice that on this chart, there is no green bar because the criteria for entry has not yet been met. It would take a little more time, a little more downside action, but the stop would be here. And so this is a stock you would keep an eye on, but it's not ready for entry. Going to the next stock, then I'll move on to some weekly examples. You know, right off the bat, this is not a good company to invest in because you can see its financials it's losing more and more money. So even though everything else looks good, I would ignore this. You don't want to deal with a company that's losing money because if it keeps losing money, it's going to go out of business. Let's go on to the weekly examples, and then I can open this up for questions and answers. Also show you some real-time trades and positions and results and stuff. Okay, this is now moving into the weekly category, so I'm going to have to change the time frame here. And you can see once again that, did we do this? I don't know, I'm not sure why I didn't show this. There may not be enough history on the stock. It's clearly making new 52-week highs, so this would be green. There may not be enough history, though. I'm not sure why it's not showing up. But I'm assuming that it's going to be green because we are making all-time new highs. So all of these would be green. The trend, of course, is positive on the weekly time frame, and we're oscillating below the upper channel. You see, once again, we moved up, came down, we're moving up, and now we're coming back down. Financials are improving. So this would be a stock that we can consider entry psychologically. We have all the fundamental and technical information we need, and we're looking for psychological. So here you can see where it's showing a green bar, and that means that psychologically speaking, two of the three different types of traders, the trend followers and the bargain hunters, are currently being stopped out or going short. So see the arrows are facing downward. They're doing the wrong thing based on who's currently in charge of this market, which is the emotional top and bottom pickers. So this is a time where entry into this market would be justified, and your stop, of course, is defined based on psychological conditions, which is going to be right there. Now, one thing I didn't mention, which is really cool, you'll notice up here where it shows based on the account size. This is the customer account. It has a little bit more than $50,000 in it right now. I try to keep it around $50,000, so I might add or subtract money just to keep it around that area. The current recommendation is telling you the cost of entry, which is about 6% of the total money in the account. It always uses 6% as the amount used to invest, so that you can have 20 or 30 positions in the market. It tells you what number of shares to buy, and it always does this in multiples of 3, and it tells you what 1/3 of that is, so you can exit your position in thirds. It tells you where your stop would be if it's a 15%, but that's way higher than the NRT recommended stop. So when you're going to take positions with this, you always want the lower of these two. Since this one is higher than the recommended stop, you'll watch these numbers up here. You grab this thing and you bring the stop down to the recommended stop, and you notice it automatically adjusts the recommended size and what is 1/3 and the amount of risk that it'll take and how much money you're going to have to spend, so that when you get in, you're still going to only be risking about 1% or less of your capital. This is a very crucial part of financial survival in the market, that you're not risking too much. So if you do get stopped out, it's going to be a 1% loss or less. So that's one of the cool new features that has been developed in the last, say, 6 or 9 months, which allows you to always know exactly how many to take. You don't have to get your calculator out and figure this stuff out. You know how many positions to take, where your stop is going to be, and when it's time to enter. Let me move on to maybe another weekly example, and then I'll go to the daily real quick. Okay, again, you can see across the board, everything is green, which means this is a good river environment dinner. This is a good oscillating time frame dinner. You can see previous trades we took right here as the market was bottoming, and these are exits that we took for this particular trade. We're no longer in this, but that shows you where we got in and where we got out. We didn't get out based on this chart. We got out based on river charts, which are these charts here, but just wanted you to see that. Okay, so everything looks good here. So this is now oscillating back below the upper line for the proper time frame based on how fast the market's moving. And then you go to this time frame and it picks the chart that's best for trading. You can see again here was the buy and here was some of the exits. And now it's indicating that a weekly chart is the best time frame to trade. And in a price environment, which is a trend following environment, you're looking for the market to drop back down into a previous corrective zone, which is currently doing, and is providing a stop. We are not currently getting a green bar, unfortunately. So it means the conditions aren't quite right for entry. We want to have certain traders that are along the market. Everybody, the trend followers, bargain hunters, and top and bottom pickers are all currently long, so they're all making money. You want to wait for one of those groups to be stopped out, and as they get out, you can get in at the best price possible. So I wouldn't enter right now, but it's looking pretty good. I'm going to pick one daily chart, and then we'll move on to some other stuff and go into questions and answers. You know, notice the weekly chart is the current selected time frame, but it's yellowing it out because it's moving much quicker now. It's telling you to use daily time frames. So we're switching over to the daily chart, and you can see we got a buy signal from my mode index just 2 or 3 days ago. You see where it was indicating the market was getting overbought over here and sold off. But we're getting a buy signal right now. Financials look good. Direction looks good. Power and momentum looks good. Acceleration recommends the daily time frame. So we're going to go to a daily chart over here. And this is the challenge for this particular environment based on who's in charge of the trend. You can see we're moving into the bottom of the channel. The recommended stop is just a few ticks away from where the market's trading. I'm not seeing a green bar, which makes this a little risky to enter, that the conditions aren't quite right yet for entry. I would consider, because the risk is incredibly low, but you would want to use the bigger of the two stops. Remember earlier I took this and I moved it down to the recommended stop. Well, here you can see the recommended stop and the 15% stop is lower than the recommended. So if I got in, I would use the lower of the two. So that way you're continuing to risk your 1% amount at entry. Okay, so that gives you an idea of the overall picture. And now we're going to take a look at some actual results in the customer trading account. This is we've only invested a very small amount lately. We're only using like 2/5 of the money, maybe slightly less than that, because wave theory, this is when wave theory can be useful. Wave theory is warning me that the stock market's near a major top and that we could go through a significant reaction or sell off in the next few months. So I don't want to be heavily long, but we do have some long positions we've been in for a while. You can see here 70% of our positions are making money. Frequently that's 80, 85, or 90%, just lately because the market's been getting a little more tumultuous, that they're not doing as well as they were. And we've reduced most of our positions down quite dramatically. So you'll notice that, 3,000 is the full position. Most of the positions are only 1/3 or less, maybe 2/3 here, but most of them are not full positions anymore. And as far as the losing positions, we have three positions here, losing 5%, 5%, and 1%, 1.5%. If you were to take the losers and separate them from the winners, we're making 4 or 5 times more on our winners than our losers. Most often, though, it's more like 10 times more, 20 times more. I've even had it 100 times more. But lately we've had 20 or 30 positions normally, and we've exited most of those. So we've been taking off most of our profits over the last, couple of months, and we don't have much left. But anyway, it just shows you, even with a limited number of positions and taking off most of our profits, we're still doing pretty well. We're up 7% overall. And so this is our profit protection app. It tells you specifically what stocks to focus on. So it's going to highlight ones that might need a little bit of attention. If it's red, that's something that's more serious. If it's green, it's making money and you would review them. So let's just go through a few of those that are coming up in the list. So here's HIMS, and it's showing that it's up 32%. We've taken off about 2/3 of this position over time. Here we have just the fundamentals and just the technicals, and I leave the psychologicals for this page. So we originally got in, this is another cool feature I didn't mention. It's called the trade line or the trade bar. You drag this line to where you got in, and then it's going to recognize how fast the market was moving at that particular point in time, and it's going to tell you which time frame is the appropriate time frame based on entry to look at, and then you can use that information to decide if the market's still safe, overbought, oversold, anything is going wrong with its trend. So here, fundamentally, everything looks good. Technically, we're still in an uptrend. Everything's green, looks fine. Psychologically, you can see here that we've reached the top of the channel. We got in over here, and we see these little gray triangles. We took off 2/3 of our position in this area, and that's based on rules for a time environment. You look down here, it says time. You go to this chart, and in a time environment, you're getting in preferably in the bottom half, below 50%, and preferably as close to this line as possible. And if it reaches the upper resistance, you want to drop down to only 1/3 long. So we were in the market, and then we got out of 2/3 of our position when it moved up to this area. And the stop for a period of time was on a daily chart, but now it's slowed down. So we're on a weekly chart. You can never increase risk on a position, so I'm not going to lower the stop to the weekly recommended level. I'm just going to leave it here until the weekly stop catches up with our stop, and then we can raise it after that. But anyway, we got in, we made money on the position, and we're still in profit for 2/3. We're currently making $283 on 1/3 of our position. Let me pull up another one. Onan is one that's making money, and then I'll look at the losing positions. Okay, so again, we have our trade bar, which is telling us to move that to where we got in. TradeStation shows me where we got in with these green arrows. It's telling me the time frame that's appropriate based on entry is monthly, so I have to do this again. Okay, so we got in at this time frame. This chart is not looking right. I don't know what's going on with they're not staying proper. Okay. So we can see from a monthly perspective, things still look great, positive across the board. Weekly, everything is still green. We're not getting any warnings of an overbought condition yet, where we get like a yellow dot. And grab this and move this over. We are currently 2/3 long this market, and you can see it's starting to speed up. We got in when it was in a monthly oscillation zone, and it's now moved up to a weekly oscillation zone. So this means that we can actually raise our stop from a monthly chart to a weekly chart. So I'm going to move this over here. You can see where we got in was right here, this horizontal line in this vertical arrow. We got in here. The market's moving in our favor. We took a partial profit on the position here, but we're still 2/3 long. And the stop is on the weekly because it initially had moved faster to allow us to do that, but apparently now it's starting to slow down, at least as of today. This is a day-by-day assessment, where this is a week-by-week and month-by-month assessment. But as of this moment, according to this, it's moving a little bit slower. So it would say that the monthly chart should be the focus, but our stop was already moved to the weekly time frame, so we can't lower it. And so that's how that trade's going. Okay, let me look at the two losing positions, and then we can do some questions and answers. Okay, on this stock, we got in when it was in a monthly oscillation zone. Everything looked great there. You can see the entry point here. The market's in an uptrend, and I guess there's nothing else to say there. We have our stop initially based on weekly. There must have been a point where it sped up some, so we moved our stop to a weekly chart. You see the market's trading within just about 44 cents of our stop. We're still long. Who knows if we'll be stopped out? But at some point, we moved our stop from monthly to weekly, and now it's back to monthly. But you can never increase risk on a trade, so we just leave it there until it catches up with our stop placement. I'm going to do the other losing position, and then we can do questions and answers. Okay. So again, it's identifying the point of entry. It's telling me to move to weekly charts. Okay, so you can see the market gave us a buy signal a while back, but recently here was where we entered. You can see it's oscillating below the upper channel. It's on a weekly oscillation environment. And we got in just recently, right about here. You can see it's giving us a green bar, and you can see it's hard to see it, but there's a little brown line which reflects the controlling element, which is the emotional traders. And it's telling us to put a stop right here. And you see the market super, super close. So this position might be stopped out, and we'll lose about $194, which is about 2/5 of 1%. The account. So, way less than 1%, because we must have raised the stop at some point. But anyway, that's where that one stands. We're still long, and who knows what's going to happen. So that takes care of the ones we need to address. The rest of them aren't showing any color, so there's nothing really to worry about. If a position is not making a lot or losing a lot, then it's just a waiting game. You're waiting for it to perform, or you're waiting for it to go against you and get stopped out. So this allows for a super objective trading and assessment, because you're not having to pick the stocks or the markets or the categories that are appropriate. You don't have to pick the time frame for trading. You don't have to pick the kind of entries or where to put your stop. You don't have to decide where to exit. Everything is determined for you. And the Profit Protection app keeps an eye on profits and losses to make sure you're checking out those stocks that are doing really well or not doing well, and looking to see if there's anything you need to do. Okay, so let me go ahead and open this up for questions. Let's see. I have in GoToWebinar, there is a thing that says chat, and it allows you, or questions, that allows you to type in questions. And so go ahead and send those. I'm starting to get some, and we can take a look. It says, what do you think on Bitcoin 1 month and 6 months? Okay, this would be more of a prediction and stuff, but I can go through it. It's just not, I was hoping to get questions about the technology, how it works, all those kinds of things, not just what I think about particular markets. But let me just go through these as they come in. So Bitcoin right now shows positive volume flow, positive direction. It's moving fast enough to make it a consideration. If you see red dots here, that means it's moving slower than the average stock in the world. You don't want to put money into things that are moving slower. You want your money to go from point A to point B, or your position to go from point A to point B faster, so you make money quicker, not slower. So if this were red, I would not consider it, but it is moving quicker than the average stock in the world. So that's something to consider. We have been long this for quite a while. You can see where we got in, way over here, right near the lows. The current time frame is monthly, but when we were getting in, it was probably weekly over in this area. I have to pull up my pointer to see. Yeah, so it was in the weekly oscillation time frame when we first got in. So that's why it doesn't look appropriate here, but it was when we got in. The market's moved up quite dramatically, so we're up about more than 100% on that particular position. I don't know if we're still in or not, but no, we're not in that anymore. But we had gotten in way back in time over here, and currently, based on oscillation information and controlling time frame, it's probably going to stay in an uptrend, but it's not a safe entry point. We would need a really big sell-off for it to be safe to get in. And when that sell-off occurs, you would want to have 2 of the 3 trading types, trend followers and emotional traders, to get stopped out. And as they're getting stopped out, you would use this as your stop, at least based on current information. Okay, let me go to the next question. Um, in case of drawing in our T channels manual, when should we change? I'm going to start at the top of the list because these things move around as I start to read them.